rational, maybe even profitable, when the market feels like it's doing everything possible to push you off course. Today, we're doing a deep dive into a real cornerstone text, Benjamin Graham's The Intelligent Investor.
Ah, a classic. Still so relevant.
Exactly, and it came out way back in 1949, but honestly, it's seen as the foundational book if you're serious about investing.
It really is.
Our goal here is pretty simple. Unpack the core ideas, pull out the key insights for you, and show why it still matters so much today. Graham, of course, people call him the father of value investing.
That's right. He sort of laid the groundwork for so much that came after.
And right off the bat, Graham makes this really critical distinction, doesn't he? About investing versus speculating.
Oh, absolutely. It's fundamental.
He really pushes for making informed decisions based on, long-term value, not just trying to time the market or chase quick profit.
Yeah, and it's more than just words. He's trying to instill a whole mindset, a disciplined one.
Yeah.
And that naturally flows right into his main strategy, value investing.
Which sounds simple, but there's depth there.
There is. I mean, the basic idea is trying to buy something for less than it's worth, like buy a dollar for 50 cents, as the saying goes. But it's not just about finding stocks that look cheap. It demands real research. You have to dig into the fundamentals.
What does that mean exactly? Fundamentals.
Good question. It means looking at the actual business consistent earnings, a solid balance sheet, a business model you can actually understand, not just market hype. He stressed understanding a company's intrinsic value, what it's genuinely worth based on its assets, its earning power, separate from whatever the stock price is doing that day.
Right. And connected to that is the margin of safety.
Yes. Crucial concept, the margin of safety.
It sounds like a buffer, but it seems like more than just a cushion against losses.
It is, much more. It's Graham acknowledging reality. It's his protection against being wrong sometimes. Because you will be wrong sometimes, even if you're smart. It's also protection against the market's craziness. It builds in room for error, minimizes your downside risk.
Okay, let's shift to maybe the most famous part of the book for many people, the Mr. Market analogy.
Mr. Market, everyone remembers him.
He's this moody business partner, right?
Right.
Offers crazy prices sometimes, lowball prices other times. But what's the real takeaway there?
Well, Mr. Market isn't just about market volatility. He's really a metaphor for your own emotional reaction to that volatility. Graham uses him to teach you emotional discipline, to stay rational, objective. Your investment's value isn't defined by Mr. Market's mood swings.
So you use his moods to your advantage.
Exactly. You take advantage of the fluctuations, buy when he's depressed and selling cheap, maybe sell when he's overly optimistic and offering a silly price. Don't let his mood dictate yours. This is super helpful during what Graham called market hysteria, those times of wild panic or irrational buying frenzies.
I think we've all felt that pull, haven't we? To panic sell or jump on a bandwagon. How does remembering Mr. Market help resist that?
It anchors you. It forces you back to the facts, back to that intrinsic value you calculated, instead of getting swept up in the crowd's emotions. It makes you ask yourself, am I reacting to the actual business reality or just to market noise?
It's a powerful mental check. Now, we should be honest, the book isn't exactly a light beach read. It can be dense.
That's fair. Yeah, it can be. There are numbers, calculations. It might take a couple of passes to really absorb it all.
Definitely.
But those numbers, they aren't just academic. They're tools to support the rational mindset. They help you ground your decisions in something solid, not just gut feelings or what everyone else is doing.
And the influence is undeniable. I mean, Warren Buffett.
Right. Buffett famously called it by far the best book on investing ever written. He always credited Graham as his mentor, shaping his entire approach. That tells you a lot.
It really does. But playing devil's advocate for a second, today's markets move incredibly fast. Is there a risk that Graham's very patient, research-heavy approach might be, well, too slow sometimes? Miss opportunities.
It's a valid question people raise. Some might argue you need to be quicker today. But I think Graham would say that mistaking speed for insight is dangerous. His focus was always on deep understanding first. That kind of knowledge takes time. It's about building sustainable wealth, not just reacting to every blip on the screen. It counters the idea that faster is always better in investing.
So, wrapping this up, it seems clear The Intelligent Investor gives you this incredibly solid framework. It's all about discipline, patience, thinking rationally.
Absolutely. The real wisdom Graham offers isn't some secret formula for getting rich quick. It's about understanding value, yes, but maybe even more importantly, it's about mastering your own psychology as an investor.
That's a great point. So here's something to think about. Reflecting on that Mr. Market idea, where in your own decision-making, maybe financial, maybe something else entirely, could you use a bit more of Graham's cool-headed, rational objectivity?